Welcome back. In this video, I'm giving a summary of fundamentals of capital budgeting. Remember, this is the last video in a series of 4 videos about capital budgeting. We've had a video about forecasting earnings, about the free cash flow and NPV. We had a third one about analyzing the project with sensitivity analysis. And this video is number 4, in which I'm going to give a summary. So when we're going to calculate the net present value of a project, we need to determine its incremental cash flow. We have to follow a set of rules. The first rule is that we need to forget sunk costs in the cash flow calculation. We also need to be aware of the allocated overhead costs. So if the company has fixed costs that it has to pay in any case, then you need to exclude the fixed costs from your cash flow calculation. You need to include all side effects, taxes, opportunity costs, and also remember that the underlying asset may be sold at the end of the lifetime, so you need to include your salvage value. And also you need to include changes in net working capital. And change in net working capital can be measured by the investment or disinvestment. And also that is something that you need to include in your cash flow calculation as well. So let's look at a very simple way of calculating the net present value. Looking at example 1, we have a investment at T0 which is 100,000 euros. We have a future cash flow that we are going to expect at T1 of 120,000 euros. The discount rate or cost of capital, so cost of capital is equivalent to discount rate and the other way around, so it's the same thing, is 10%. The question is, what is the NPV and is it larger than 0? Well, the NPV calculation is presented over here. This is the investment at T0, and this is the present value of the future cash flow after 1 year. So we divide 120,000 by 1.1 to the power 1. And the outcome is 9,091. So the NPV is positive for the simple reason that the present value of the cash inflow is larger than the present value of the cash outflow at T0. And therefore we have a positive NPV. And our conclusion would be is that we need to go ahead with the project. Let's further look at example 1 in the context of IRR. IRR is given at 20%, which means that the total return of the project is 20%. We know that our cost of capital is going to be 10%. So on every euro that we're going to put in the project, we get 20%. But we need to pay 10%, 10 cents on the euro. So the present value of the difference between 20 and 10% is actually 9,091,000, which is equivalent to the NPV of the project. So in other words, how does this work? The IRR is larger than the discount rate. So that means that you would have a positive NPV. And a positive NPV would mean that you need to go ahead with the project because the project adds financial value to the firm. Let's look at example 1, but now in the context of IRR, which stands for internal rate of return. The IRR of this project is 20%, that's given. And the discount rate or cost of capital is 10%. So on every euro we put in our project, we make 20%, we need to pay 10%. So in other words, the IRR at 20% is larger than the discount rate at 10%. That means that we would have a positive NPV, and a positive NPV means that we need to go ahead with the project because it adds financial value to the firm. So in sum, when the internal rate of return is larger than the cost of capital, like in the example in the previous slide, we would have a positive NPV. If the IRR is equal to the cost of capital, then we would have a 0 NPV. If the IRR is smaller than the cost of capital, then we would have a negative NPV. When the NPV is larger than 0 and when the NPV equals 0, we need to make a decision to accept the project. If the NPV is smaller than 0, so it's negative, and that is when the IRR is actually smaller than the cost of capital because our return is not sufficient enough to pay the cost of capital, then we would have a negative NPV and we would need to decline the project. Let's look at example 2. Example 2 has a project with an economic life of 4 years, 0, 1, 2, 3, and 4. At T0, the project has a negative cash outflow of 8,000, which is the investment. At T1, it's going to expect a cash flow of 5,000, 2,000, 1,000, and in T4 they have a positive cash inflow of 4,000. The discount rate is 8%, so the cost of capital is 8%, which means that you need to pay your capital providers 8% on every euro they're going to give you to invest in a project. The NPV is the initial investment plus the present value of all the cash inflows. Well, the present value of the investment plus all the present value of the cash inflows gives you an NPV of 2,078. Which of course is a positive NPV, and a positive NPV means that the project adds value to the firm. Furthermore, we have used Excel spreadsheet to calculate the IRR. Obviously, if you would like to ask yourself, do I really understand the concept of IRR without using Excel, you should know that with a positive NPV, obviously the IRR should be larger than the 8%, okay? And the spreadsheet in Excel actually gives us a IRR of 20%. So we actually already knew that it should in any case be larger than a discount rate because, we have a positive NPV. And we know that if we have a positive NPV, we should have a IRR which is larger than the discount rate. Another way of looking at the cash flow analysis is looking at the payback period. Because you can ask yourself, okay, so if I invest 8,000 at T0, how many years does it take to earn back the investment, excluding time value of money? Well, in that particular case, we need to wait for 3 years. Because we've invested 8,000 at T0, the first cash flow is going to be 5,000, 2,000, and 1,000. So in other words, the owner of the project needs to wait 3 years to earn back the initial investment. Let's have a look at example number 3. The case is about a company that produces steel and it is considering an investment in solar panels. The capital expenses at the beginning of 2021 amount to 50,000 euros. So this is the initial investment at 2021. The economic life is 20 years. At the end, there is no salvage value. So we can't sell the underlying asset for anything at the end of the economic life. The energy cost savings, so the incremental savings, are 5,000 per year. The cost of capital is 5% and the tax rate is 20%. 5 questions. Question 1. Why is the cost of capital or discount rate relatively low? Question 2. The additional operating income per year. Question 3. What is the cash flow per year? Question 4. What is the net present value? And question 5. What is the IRR of the project? On the next slide, we're going to start with question 1. Question 1, why is the discount rate relatively low? Well, that is because we are dealing here with a solar panel asset that produces energy savings. And I think you can actually argue that the energy savings are pretty secure. And that is also why we have a low risk and we can use a relatively low cost of capital in the project analysis. Question 2, what is the additional operating income per year? Well, the incremental cost savings are 5,000 and you need to deduct your depreciation of your panels of 2,500. So that makes that your additional operating income, your additional EBIT, is going to be 2,500 per year. Question 3, what is the additional free cash flow per year? Well, we have, like said, an additional EBIT of 2,500. We need to deduct the taxes of 20% directly from the operating income, 500. So 2,000 is considered the NOPLAT, net operating less adjusted tax. Then we need to add the depreciation, 2,500. So 2,000 plus 2,500 gives us a additional operating cash flow of 4,500 per year. The question 4 is, what is the NPV of the project at the beginning of 2021? Okay, the first thing that we are going to do is we're going to calculate the present value of a stream of cash flows valued at 4,500 for 20 years. Now, we can use a formula that is well established in the finance literature that goes as follows. The present value of a stream of 20 cash flows is the underlying cash flow, which is 4,500. 1 minus 1 plus R. R is the cost of capital at 5%. The N is obviously 20 years, and R is again 5%. Well, if you fill in the numbers in the equation, you will get to the present value. The present value is going to be compared to the initial investment. Okay? Well, the present value of all the cash inflows less the investment gives you an NPV of 6,079.95 cents. So this means that the NPV is positive and the project is going to add financial value to the firm. Question 5 is, what is the internal rate of return of the project? Well, we used Excel for that, and Excel gives us an IRR of 6.39%. Well, how do we know if this is correct? We're going to fill in the 6.39% into the equation that we also used in a previous slide. And the outcome is indeed a NPV of 0. So in other words, if we're going to fill in 6.39% into the equation, the NPV will be 0. Furthermore, we can see that the IRR is larger than the cost of capital. And that makes sense because we would have a positive NPV. And since the NPV is positive, our total return obviously should be larger than the cost of capital. So in other words, looking alone at the IRR of 6.39%, we can argue that we would have a positive NPV because it's simply larger than the cost of capital. Example 4 is about the incremental cash flow of depreciation. Now, in table 1, this table on the left-hand side, we have a cash flow overview without any depreciation, because here you see depreciation is 0. Okay, and here also 0. Now, here we have the same organization, but then with depreciation, 30,000 over here and 30,000 over there. Now, if the question is, what is the incremental cash flow of depreciation, then the answer is 6,000. And how can we get to 6,000? That is because in this table here, without having any depreciation, we pay taxes over the EBIT of 50,000. So the taxes in total is 10,000 in the case we have no depreciation. In the case we do have depreciation, we pay a 20% tax rate over a lower EBIT because we have deducted depreciation from its revenue. So in other words, that would decrease the EBIT. And because the EBIT has decreased, we pay a lower amount of taxes. So in other words, an answer to the question is, in the original situation without any depreciation, you pay 10,000. In a situation in which you do have depreciation, you pay 4,000. So the incremental cash flow of depreciation is obviously 10 less 4 is 6,000 euro. We also call the 6,000 euro the tax shield related to depreciation. Example 5. This is the last example in this video. The question is about the cash flows and the NPV. So what is the NPV of this project? The case is about you're considering the purchase of a new machine at the beginning of 2021. The cost price is 800,000 euros and the economic life is 5 years. We do have salvage value of 200,000 euros. And we use the straight line depreciation method. We're going to save wages for 300,000 each year. Okay? The machine is installed in a part of the factory that was rented out up to now for 30,000 per year. So this is opportunity costs. The tax rate is 20% and the cost of capital is 15%. Now, let's break down the calculations in two. The first question is, what is the cash flows that this project would generate in year 1 until 5? And then question 2 is, compare the present value of all the cash flows from year 1 until 5 with the initial investment at T0. Let's look at the first question, and that is, what is the cash flow from year 1 until 5? We have cost savings of 300,000 euros per year. So this is the incremental cash flow coming in. We have a loss of rent, which we call opportunity cost of 30,000, which we need to deduct from the cost savings. And we have a depreciation expense of 120,000. Now, how do we get to 120,000? That is the machine cost price of 800,000 less the salvage value at the end of year 5, which gives us 600,000, divided by 5 years, which in other words gives us a depreciation expense per year of 120,000. The additional EBIT is 150,000, which is 300 less 30 less 120. We pay taxes over the EBIT of 30,000, so 120,000 is called the NOPLAT, net operating profit less adjusted tax. Okay? Then we need to add the depreciation, because we know that depreciation is not really a cash expense, and therefore we need to add it up. And then we get an additional cash flow of 240,000. So in other words, from year 1 until year 5, we have a cash flow coming in of 240,000 euros. The answer to question 2 is, what is the NPV? And the answer is 103,953. So in other words, we would have a positive NPV. How do we get to this number? We take the initial investment over here, which is minus 800,000 cash outflow. We just said that we had a cash inflow of 240,000 per year for 5 years. So here, year 2, 3, 4, and year 5. However, remember that we also have the salvage value coming in cash flow of 200,000. So 240,000 of cash flow coming in, plus the 200,000 from the salvage value makes 440,000. So if we're going to make the present value calculation, we can see that the present value of all the cash inflows is larger than the present value of the investment, and therefore we would have a positive NPV. And like said many other times in this video and in the previous videos, if we have a positive NPV, it would mean that we need to accept the project because it adds financial value to the firm.